Hey guys, it's me, Desi Arnaz, professional investor. And look, I want to take a couple minutes and share a brief case study with you guys of an actual mortgage note that was for sale by the lender. And I want to show you the three possible outcomes that you can expect anytime you invest in a mortgage note and how those three outcomes will impact your yield, your safety, and your investment. Okay, so pay attention. I think you guys are really going to enjoy this, and I'm sure it's going to help you have a much better understanding of why note investing makes so much sense for so many people. All right, so let me share my screen right now. All right, so here we are, guys, and what I want to do is I want to share with you the case study of a little house in Akron, Ohio, okay? And I'm going to tell you all about this particular asset and how it was for sale and how it worked out in the end of the day. So, as I said, it's a little house in Akron, Ohio. At the time, the market value of this little place was $60,000. That means that a real estate agent or an appraiser said that's how much that house would sell for in that market. Now, the homeowner only owed $48,000 to the lender. That was their balance remaining on their mortgage, and they were paying $494 a month, and they had 10 years left to pay. Here's the thing, though. The lender, even though they were owed $48,000, was willing to sell this mortgage note for only $39,000. That means the day that you buy this mortgage note as an investor, you have $9,000 in equity in that mortgage. Think about that for a minute, because typically speaking, the only way to get equity in real estate is either to put down more of your own money to get that equity, or buy the property, sit back and wait until it goes up in value so that you can get equity. You hope it goes up in value, right? That way you can get some equity. Well, when you buy a mortgage note, you buy it at a discount and you get instant equity, okay? So now you may be thinking, okay, what's the risk? Well, here's what I want to tell you. Anytime you invest in a mortgage note, there's only three possible outcomes. One is that the people are going to pay you like they're supposed to. We call that paying to term. They just keep paying. In this case, for the next 10 years, they just make their payments, and that's that. Or they're going to pay you off early. Now, what does that mean? That means maybe they sell their house. So suppose after 5 years, they decide to move. So they sell their house and they pay you off. That can happen. You can't stop that from happening. And the third possible outcome is the people just don't pay you at all. And if that happens, then you have some recourse. And we're going to talk about that right now. So let's look at option one. The people pay you to term. That means that for 10 years, you would collect $494 a month. That's 120 payments of $494. You do the math, and that comes to $59,280. Using your financial calculator, it's pretty easy to determine that your annual yield each year was 9%. Think about that, 9%. Your money's growing at 9%. And here's the beautiful thing about that. Your money's growing at 9%, whereas if it were in the bank, it would be growing right now at less than 1%. Think about that for a second. That means it would take 9 years in the bank to make what you make in 1 year in this investment. This is one of the reasons why investing in notes is so powerful. And remember now, we do have collateral with this particular investment. Unlike the stock market, there's nothing backing up your investment except the people that are running the companies where your stock is invested, where your money's invested, I should say. So that's option one. Let's look at option two. Maybe they pay off early. So let's just say they pay you for 5 years, and then they decide they're going to sell their house and buy another house. Does that happen? You bet it does. The average person moves about every 5 to 7 years. So 5 years in, they decide they're going to sell their house. That means you will have already collected 5 years of payments. That would be 60 payments of $494. Now that comes to $29,640 in payments that you've already collected. Now, when they pay you off, they still owe you another $26,595. Think about that now. So you add those two together, what you've already collected plus what they still owe you when they pay you off, Now you've received $56,235 on a $39,000 investment, and you did that in 5 years. Stick that into your financial calculation, and you will see that your money has been growing at an annualized rate of 11%. That is fantastic. An 11% growth rate. There's no one that can complain about that. But here's what's on everyone's mind. Suppose they don't pay, right? Suppose they don't pay. How does that actually play out? Well, let's look at it. Let's use the same scenario. 5 years in, they've made payments for 5 years, and then all of a sudden they just stop paying. Maybe they lost their job. Maybe they got divorced. Someone got sick. Well, who knows? But for whatever reason, they stopped paying. So over the 5 years, you would have collected $29,600. Then you're going to sell that house for $60,000. And out of that $60,000, you're going to have to use some of that money, right, for foreclosure fees to your attorney. That's usually about $2,000 or $3,000. You're going to pay your realtor, and you're going to pay some closing costs. So let's just say out of the $60,000, you wind up with $51,000 in cash in your pocket. Now remember, over the 5 years, you've already collected $29,600. Now you're going to get another $51,000 from the sale. You do the math, and that comes to $80,640 in this example. What kind of a return is that on your investment in 5 years? That's a 17% return on your investment per year. Dude, it just doesn't get any better than that. You see, here's the thing. Only one of these three things will happen. That's just the way it works. Either they're going to pay you like they're supposed to, or they're going to pay you off early, or they're not going to pay you. And when you invest in mortgage notes, you're covered either way. Doesn't really matter. You don't go backwards. I like to say that about note investing. You don't go backwards. That's why banks don't flip houses. This is why banks don't become landlords, don't put their money in the stock market or Bitcoin. This is why banks lend, because the power is in being the lender. Okay? You can do it. You can buy mortgage notes that have already been placed into service, and you can buy those notes at a discount, just like I do, and then you can collect that interest for decades, just like I do. That's called financial literacy. And if you want to leave something for your children, for your family, leave a financial legacy of financial literacy. That's what you want to leave. You need to learn this stuff yourself, right? So that you can put your money to work. Whether your money is in a savings account or it's in a retirement account, doesn't matter. You can use your retirement account to invest this way. All you need to do is to make your money self-directed. Make it a self-directed retirement account. Okay, can you do that? Of course you can. You can self-direct your retirement account. Speak to your custodian about that. And if your custodian won't allow you to self-direct it, don't worry about that. Just switch custodians. That's what you have to do. If you want to learn more about how to do this, just go to my website. It's investbrilliantly.com. Click on the button that says, tell me about your coaching program. Because I have a coaching program that'll teach you how to do this stuff. Whether you have a savings or don't have a savings, it's not really relevant. I have two different programs. One for those of you that have a savings and you're ready to get started investing your own money. Another is for those of you that do not have any money to start, but you really do want to build a better life for yourself and for your family. And so I teach you how to use other people's money to invest in mortgage notes by helping other people invest in mortgage notes too. So if you'd like to do it that way, it doesn't really matter, but you do need to do something. If you want to have a better life, if you want to have passive income coming in for decades, then check out our coaching program. Go to investbrilliantly.com. On there, I have a video that explains how the coaching program works, tells you what the cost is. If you're interested, just sign up. If you're not interested, that's okay. But check it out because you deserve to know your options. What do you think? You think that's a pretty good thing? Well, I sure did when I first saw it back in 2013. I thought it was a great way to invest money, and it has completely changed my life. And I am now helping other people to change their lives for the better, to get a financial education, to get financial independence and freedom from having to work a job and counting on a boss not to lay them off, right? I mean, that stuff gets old. If you want a better life for yourself, there is an opportunity. This is America, and there is a way that you can do this. Just go over to investbrilliantly.com. I'm Desi Arnaz. Thank you so much for your time. God bless you.